Ladies and gentlemen, the silver market is approaching a structural break that the financial system has spent 4 decades assuming could never happen. When it resolves, the people holding the wrong form of the asset will discover that exposure and ownership are not the same thing. What follows is a precise account of the forces converging on silver right now. The distinction between the market most investors observe and the one that will actually determine outcomes and the framework for positioning ahead of a repricing event whose mechanics have no modern equivalent. The objective is not to predict a specific price or date. It is to understand why the conditions that historically produce silver's most dramatic moves are now present in combination, and why the standard ways most investors gain exposure to silver may not deliver what they expect when those conditions finally resolve. The macro backdrop matters because every commodity story is ultimately a monetary story first. We are living through the longest sustained period of monetary distortion in the documented history of central banking. Interest rates were held near zero for over a decade across the developed world. Central bank balance sheets expanded at a pace that has no historical parallel. The cumulative effect was to inflate virtually every traditional asset class to valuations that only make sense in a world of permanently cheap capital. That world is ending. It is not ending through gradual normalization because the debt levels accumulated during the easy money era now make true normalization impossible without triggering the very crisis the policy was designed to avoid. It is ending through the slow recognition that the system must either accept persistently higher inflation or accept the consolidation of paper claims that decades of monetary expansion have created. Inside that recognition, hard assets reassert their value. This is not theory. It is the documented pattern of every previous monetary regime change in modern history. When the monetary unit loses credibility, capital migrates toward assets whose supply cannot be expanded by policy choice. Gold has been the obvious beneficiary of this migration, so far with central banks themselves accumulating at the fastest pace in decades. But silver occupies a position that gold does not, and understanding that distinction is the foundation of everything that follows. Silver is the only major monetary metal that is also an essential industrial input at scale. Gold's industrial uses are real but secondary to its monetary role. Silver's industrial uses are enormous, irreplaceable in their primary applications, and growing at a rate that the mining industry has no visible capacity to match. This dual identity means that silver is simultaneously exposed to two separate sources of structural demand, and those sources are intensifying at the same time for the first time in the metal's modern history. The first principle for understanding what is coming is to separate the market most investors observe from the market that will ultimately determine outcomes. There are two silver markets, not one. The market that sets the price quoted in financial media is the COMEX, where silver futures and options contracts trade in volumes that vastly exceed the physical metal available for delivery. On any given day, the paper silver market processes transactions representing hundreds of millions of ounces. The physical silver market actual bars, coins, and industrial inventory is a fraction of that volume. The ratio between paper claims and physical metal available for delivery sits at approximately 250 to 300 to 1. That ratio is not hidden. It is documented legal and considered normal market functioning by every regulatory body and exchange that oversees it. But the description normal market functioning rests on an assumption that becomes critical when stress arrives. The assumption is that holders of paper claims do not demand physical delivery in numbers that would test the inventory available to satisfy those claims. For 4 decades, that assumption has held because the participants in the paper market were institutions, funds, and traders who wanted exposure to silver price movements, not the metal itself. They rolled their contract forward. They took settlement in cash. They treated silver as an abstract financial instrument rather than a physical commodity. The system worked because everyone agreed to treat the paper as if it were the same as the metal. The second principle is that this agreement is not a law of nature. It is a behavioral convention that can be broken when participants change what they want from the market. In 2020 and into early 2021, retail investors began purchasing physical silver at rates the modern market had never experienced. Government mints reported backlogs measured in months. The United States Mint suspended sales of silver eagles entirely. Dealer inventories were depleted. Premiums on physical silver above the spot price, which had historically averaged 3 to 5% for standard bullion products, expanded to 30 and 40% in a matter of weeks. The QMX paper price barely moved during this period. That divergence was the market telling investors something important. Even if most of them did not understand the signal, the physical market was registering a supply crisis. Premiums were screaming that there was not enough metal available to meet the demand arriving. The paper market, structured around 250-to-1 leverage, absorbed the pressure with minimal price response because the mechanism for price discovery in the paper market does not require physical metal to exist. It requires only that buyers and sellers of paper claims continue transacting. The two markets linked for 40 years by the convention that paper represented. Physical briefly revealed that the link is conditional. They diverge. The divergence was temporary because the physical demand wave subsided before it tested the system at a scale that would have forced permanent reconciliation. Now imagine the same divergence occurring in a market where industrial consumption is structurally higher and where monetary demand is rising rather than receding. This is the third principle. The conditions that produce silver's largest historical moves are not present individually. They are present in combination, and they reinforce each other. The two most significant silver rip risings in living memory occurred in 1979 to 1980, when the price rose from under $6 to nearly $50, approximately 14 months, and in 2010 to 2011, when it rose from under $20 to $49 in roughly 8 months. Both moves occurred in environments that were less extreme than the current one on every measurable dimension. Total debt levels were lower. The monetary base was smaller. Industrial silver consumption was a fraction of current levels. The geopolitical fragmentation that is reshaping global capital flows had not yet begun. Each previous move occurred when only some of the structural conditions were present. We are now in an environment where all of them are present simultaneously. The industrial demand story is the dimension that most distinguishes the current setup from any previous silver cycle. Solar panel manufacturing has become the single largest industrial consumer of silver, and the metal's role in photovoltaic cells is not optional. Silver is the most electrically conductive element known, and substitutions tested over decades have produced efficiency losses that solar manufacturers will not accept in a market where panel efficiency is a primary competitive variable. In 2023, global solar installations consumed approximately 200 million ounces of silver. Total global mine production in the same year was roughly 820 million ounces. Solar alone accounted roughly 1 in every 4 ounces produced. The projections for solar deployment through 2030 implies silver consumption from photovoltaic manufacturing that by some credible estimates will approach or exceed current total global mine output from solar alone. That projection does not account for electric vehicles, which use 4 times more silver than internal combustion vehicles. It does not account for the explosive growth in artificial intelligence data center construction, where silver is required in high-performance interconnects, circuit boards, and cooling systems. It does not account for defense electronics, semiconductor manufacturing, medical devices, or any of the other established industrial applications that consume silver consistently regardless of investment demand. When the mathematics of demand structurally exceed the mathematics of supply with no visible path to resolution, the market must produce a price response sufficient to reconcile the imbalance. This is not a thesis. It is the mechanism by which commodity markets have always operated. The question is not whether the response occurs. The question is what magnitude of response is required to bring demand back into balance with supply and how quickly the market discovers that magnitude. The fourth principle is to recognize the difference between paper exposure and physical ownership before the divergence becomes visible to the consensus. An investor who holds silver through an exchange-rated fund has exposure to the paper price. The fund's prospectus describes the metal that backs the shares, but the operational reality is that the fund participates in the paper market and tracks the paper price. If the paper and physical markets diverge meaningfully, the question of whether paper claims can be redeemed at the physical price becomes a practical question rather than a theoretical one. The answer depends on the specific structure of the instrument and on the conditions prevailing during the divergence. The investor who holds physical silver in allocated storage or direct possession holds an asset that cannot be replicated by the banking system. That distinction does not matter when the paper to physical convention is functioning normally. It matters profoundly when the convention is under stress. The historical precedent for this kind of structural test is the Hunt brothers episode of 1979 and 1902 Texas oil billionaires began accumulating physical silver and demanding delivery on futures contracts rather than rolling them forward. As their holdings grew and as other investors began following the same strategy, the paper price began to detach from its historical range. Silver rose from $6 to nearly $50 in just over a year. The Hunt brothers never controlled the majority of the silver market. Their holdings were significant but not dominant. What they did was demonstrate to a market built on the assumption that nobody would ever demand physical delivery at scale, that the assumption could be challenged, and that when it was the paper price ceiling that the convention had created would dissolve, the full repricing in that episode was halted by rule changes that effectively prevented continued accumulation of physical positions. The system protected itself by altering the rules under which the test was occurring. That the signal embedded in the price action before the intervention was unambiguous. The paper price of silver functions as a ceiling that holds only as long as participants accept paper as a substitute for metal. Remove that acceptance from a meaningful portion of the market, and the ceiling becomes the floor. The fifth principle is the timing of action relative to confirmation. Every major repricing in commodity history has been preceded by a period during which the structural conditions were visible to anyone who examined the underlying data. But the consensus continued to treat the asset as it had been treated during the prior cycle. The pattern is consistent across markets and across decades. The asset consolidates while the structural pressures build. Patient investors who recognize the conditions accumulate quietly during the consolidation. The narrative remains negative or indifferent. The financial advice industry, which is structurally oriented toward consensus positioning, does not recommend the asset because doing so would deviate from defensible allocation models. Then in a compressed window of time, the structural pressures resolve into price action. The move is fast enough that investors who are waiting for confirmation discover that confirmation arrives only after the most favorable entry prices have already disappeared. The crowd buys near the top of the move, while the patient accumulators who position during the consolidation collect the asymmetric returns. Recency bias is the cognitive mechanism that makes this pattern reliable. Human decision-making weights recent experience heavily and discounts structural conditions that have not yet produced visible results. Silver has frustrated investors during its consolidation periods. It has tested patience. It has attracted retail enthusiasm and then disappointed it. Each cycle of frustration deepens the perception that the asset is unreliable, even as the structural conditions that will eventually produce the next move accumulate beneath the surface. This perception is precisely what keeps the asset accessible at current prices. If the conditions were obvious to the consensus, the price would already reflect them. The financial advice industry plays a specific role in maintaining the consensus position. The people working in it are not dishonest. Many are competent professionals operating within incentive structures that reward defensible recommendations and consensus positioning. Recommending a meaningful allocation to silver requires explaining a thesis that contradicts the standard portfolio model and accepting career risk. If the thesis takes longer to resolve than expected, the result is that the industry systematically underweights silver across nearly every client portfolio, regardless of macro conditions. This is not a conspiracy. It is the predictable output of an incentive system that prioritizes conformity over conviction. The asymmetry it creates is real, and it is one of the few remaining structural inefficiencies available to disciplined individual investors. The mental model that captures the current setup is to think of silver as a dual-layer scarcity asset rather than as a single commodity. The first layer is monetary in a world of expanding fiscal claims and persistent monetary distortion, finite assets that cannot be replicated by policy choice command increasing premiums. The second layer is industrial. In a world of energy transition and AI infrastructure build-out, irreplaceable industrial inputs whose supply cannot expand to meet demand command rising prices regardless of monetary conditions. These layers do not offset each other. They reinforce the monetary thesis would be sufficient to justify accumulation. The industrial thesis would be sufficient to justify accumulation. The combination occurring simultaneously in the same market for the first time in modern history creates a setup whose magnitude is difficult to estimate using historical analogies because no historical analogy contains both conditions at current scale. The practical implication for portfolio positioning is not concentration. Concentration without understanding is reckless. The implication is that the standard portfolio assumption that inflation protection is adequately addressed through equity exposure, bond duration management, and a small gold allocation does not survive contact with the structural conditions now developing. Most portfolios carry substantially less protection against monetary debasement than their holders believe and substantially less exposure to the structural demand shock building in industrial commodities than the macro environment warrants.